Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 371 on April the 18th, 2025. I'm your host, Eric. And in this week's show, we'll cover the trades from last week on Snap Inc., the Direxion Daily Semiconductor Bull 3X Shares ETF, and Unity Software. And we discussed three new trades on NIO Inc., Pfizer Inc., and Lyft Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this was a shorter trading week with the markets being closed today in observance of Good Friday. The markets finished the week lower. The Dow Jones Industrial Average lost 1,070 points, closing at 39,142 points. The S&P 500 index lost 80 points, ending the week at 5,282 points. And now it's time for the topic of the week. The topic of the week is the tightrope. I've been listening to the audio version of a book called Mastering the Mental Game of Trading by Stephen Goldstein. I'm definitely enjoying the book so far and his approach to discussing trading as a performance activity. One of the examples that he gave was a tightrope. When you learn to walk a tightrope, you start with a tightrope just being 2 feet off the ground. Falling off the tightrope at 2 feet won't hurt you much, not at all, and it allows beginners to learn and practice all of the correct skills without getting too emotionally connected to the outcome. Now, when you get a little bit better, they move the rope up to 10 feet above the ground. Now, if you fall at 10 feet off the ground, you can hurt yourself, but it most likely will not be fatal. You would only practice the tightrope at this height once you've already become proficient in the techniques and required skills. Now, practicing the tightrope at 2 feet or even at 10 feet is slightly different than performing the tightrope at 100 feet off the ground. Even if you're wearing a harness, practicing at 100 feet off the ground brings in all of the additional emotions that are in your mind. Your survival mode, your fight or flight mechanisms, they might actually override your knowledge of good technique and good form. That's the same thing that happens when trading. Now, paper trading is like watching someone perform the tightrope nearby. It's just not the same at all. Trading small sizes, like one spread that's 50 cents wide, that's like using the tightrope off the ground about 2 feet. Now, as you get more comfortable, you might trade $5 wide spreads or multiple spreads with each trade. You might eventually move to the tightrope that's more like the 10 feet off the ground. The 100 feet above the ground tightrope, that's similar to trading large volumes of naked options that are not spreads at all, where you're outright trading the options themselves. And at that point, if they move against you, it might cost you a significant amount of money. Your emotions are going to be at play, and they might affect your ability to make clear, profitable decisions. In fact, I shouldn't even say might. They most likely will. The goal is to have a process that you learn to follow when your risk is small. And as you get more and more confident executing the process, you put on a little more risk. You wouldn't start off learning the tightrope with it being 100 feet off the ground or even 10 feet off the ground. In that same manner, regardless of the amount of capital you have, it's best to start trading with lower risk so that you can grow confident in your process. It's all about creating the process that works for you so that you can become more confident taking on more risk in the market. If your process is right, the outcomes will take care of themselves, even as risk grows. If you have confidence in your process, that will help ease your emotions. And trust me, if you don't think trading is an emotional game, email me when you start taking on more risk. It gets very emotional, and a lot of guys get in their head, and that affects their ability to make a profit. So start small, get comfortable with the process, and as your confidence grows with that process, add on the risk capital that will let you achieve your goals in trading. But don't do it too soon. Otherwise, it'll feel like you fell from 100 feet tightrope. All right, so let's go ahead and get into the review of last week's trades. Thanks for bearing with me on that topic of the week. I hope it didn't go too long, but I really found that book to be interesting. I didn't used to be into sort of the mental side of trading because I just wanted to know more strategies. I just wanted to know more techniques. And now that I'm at a point in life where there isn't a technique, there aren't any option strategies out there that I'm unfamiliar with because I've been doing this so long, the inner side, the mental side tends to affect my trading outcomes way more than my knowledge of strategy. So let's go ahead and get into the trading review of last week's trades. We're going to start off with the covered call like we always do on Snap Inc. Symbol S as in Sierra, N as in November, A as in Alpha, P as in Papa. At the time, the stock was trading for $7.97 per share. I looked at buying stock and selling the May 8 call at $1.02, hoping for a return of 13.17% in 5 weeks. Well, shares of Snap lost 11 cents, ending the week at $7.86 per share. The call option we sold lost 12 cents. That leaves us with a net profit of 1 cent if we were to close the trade out immediately. Now, even though the stock is off a bit over the week, the stock price is still 91 cents above our break-even point. There isn't a real reason to make any adjustments on this trade so far. This one is working out, so no adjustments are needed, but you'll definitely want to keep track of the stock in the coming weeks. Next up, we have the credit spread on the Direxion Daily Semiconductor Bull 3X Shares ETF. Symbol S as in Sierra, O as in Oscar, X as in X-ray, L as in Lima. At the time, the stock was trading for $10.25 per share. I looked at selling the May 10-9 put spread at 39 cents. That could give me a maximum possible loss of 61 cents per spread. Well, shares of SOXL fell $1.07, ending the week at $9.18 per share. The out-of-the-money put spread we sold is now in the money, or really at the money, but it's right there. The stock price is 43 cents below the break-even point, which means that we are losing money on this trade so far. Now, I always look for a call spread to sell to possibly turn this into an iron condor. However, that can also lead to a loss if the stock price rallies back. And you could close this trade right now and lock in a 19-cent loss overall, or you can sell the 9-10 call spread at 41 cents and also lock in a 20-cent loss. For now, I'm more prone to hold off a week and see how the stock is going to respond to any news next week. My inclination is that we'll see a bit more movement before it's time to lock in a loss or a profit. So just make sure you have a game plan on this trade. I love the fact that there's still 4 weeks left, so there's time before you need to make any adjustments. And again, remember, we traded a spread, so we knew what the maximum loss would be, and we trade accordingly. We size our positions not based on our maximum gain, but based on the maximum loss, so that we are managing our risk appropriately. And so now it's really just a matter of limiting how much risk we are exposed to, and of course trying to see if there's a way to change this trade around so that we can either limit that risk or make a profit. So that's it. Trade number 2 did not work out so well. Our final trade was Unity, the debit spread we bought on Unity Software, symbol U as in uniform. At the time, the stock was trading for $19.22 per share. I looked at buying the May 18-19 call spread for 64 cents. That could give us a maximum gain of 36 cents or a 56.25% return in 5 weeks. Well, shares of Unity Software finished the week completely unchanged. That doesn't happen too often. The in-the-money call spread that we bought is still in the money. In fact, you would pay a couple more cents to enter the trade this week. So all of the same economics are still at play. from the start of this trade, so no need to make any adjustment. And just so you understand how I think about this, if the stock were to expire right now at the exact same price in 4 weeks even, we would collect our maximum profit. So this is a positive outcome. If the stock stays still or if it increases in value, that's fantastic for us. So no adjustments are needed at all on this trade. It is working out, and we hope it keeps going. That's it for the trade review of last week's trades. Of course, yesterday, April 17th, was options expiration for all monthly options in the month of April. The new trades on today's show will use the May 16th expiration date. And on Monday, the 50-cent strikes will be priced in. They're not priced right now. They'll be priced in on Monday when the market opens. So there may be better opportunities than those presented on today's show. These are just the trades that I'm looking at right now. So we're going to start off with the covered call. I'm looking at NIO Inc. Symbol N as in November, I as in India, O as in Oscar. The stock ended the week at $3.52 per share. I'm looking at buying stock and selling the May 4 call at 13 cents, hoping for a total return of 17.33% in 4 weeks. Now you enter this trade by buying stock for $3.52 per share and selling the May 4 call at 13 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price on this trade is $3.39 per share. In real terms, the stock purchase would require $352 and you'll collect $13 for selling the option. And as an aside, I like looking for covered calls on stock that's really cheap. Like this is sub $5 per share. That means that overall, you're not risking that much money to get a taste of the covered call strategy and to see if it really fits your trading thesis, if it fits your risk temperament. One of the things I say on each show for the covered call actually isn't totally true. I said this trade makes the most money if stock prices finish above $4 per share. You can make the argument that this trade makes the most money if the stock goes higher than where it currently is, $3.52, but finishes lower than $4 so that we keep the stock and we keep the premium on the option, which would allow us to then turn around and sell another call option against this stock next month. And at that point, as you're rolling, if you end up in a scenario where your stock is holding its value or increasing in value, but it's not triggering the exercise of the option, you get to continue selling options against that stock and continue collecting premium. Where you lose money on a covered call is really if the stock goes lower. So if you execute a covered call, or even if you do the credit spread or the debit spread that I'm going to show in the show and on every show, I'm really pushing for stock to go higher. When the stock prices go lower, it hurts these trades. But remember, with the covered call, the stock price is where you get banged up. So if we were trading a $20 stock, that would mean you'd have $2,000 at risk. Since we're trading a smaller stock, the $3.52, all you could possibly lose is $3.52 times 100 shares, right? Because each option is worth or has an underlying value of 100 shares. So it's $352, just so you know how that's all adding up. If you're not familiar with what I just did, or if you have questions, email me. I'll probably hop on the phone with you and just have a little talk. I love helping people out. I love to teach. And as always, if it makes sense, I'll mention trading coaching. But I don't always mention that because honestly, some people aren't in a position where they would benefit from it. A lot of you are, which is great. And I've helped out a lot of people. But definitely I like making sure that you understand what I'm saying on the show, or more importantly, that you're not misunderstanding it. So that's it for that aside. Let's go ahead and get into the credit spread for this week. I'm looking at Pfizer Inc., symbol P as in Papa, F as in Foxtrot, E as in Echo. The stock ended the week at $22.14 per share. I'm looking at selling the May 22-21 put spread at 37 cents. That could give us a maximum possible loss of 63 cents per spread. Now you enter this trade by selling the May 22 put at 84 cents and concurrently buying the May 21 put for 47 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $22 per share. The break-even price on this trade is $21.63 per share. In real terms, you'll receive $37 per spread that you sell and have $63 at risk. And our final trade on today's show is going to be a debit spread on Lyft Inc., symbol L as in Lima, Y as in Yankee, F as in Foxtrot, T as in Tango. The stock ended the week at $11.16 per share. I'm looking at buying the May 10-11 call spread for 63 cents. That could give us a maximum gain of 37 cents, or that's a 58.73% return in 4 weeks. Now you enter this trade by buying the May 10 call for $1.85 and concurrently selling the May 11 call at $1.22. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $11 per share. The break-even price on this trade is $10.63 per share. In real terms, you'll pay $63 to enter the spread, and your maximum gain is $37 per spread. So that's it for this week's show. I recorded it a little bit early since today is Good Friday and the market was closed yesterday. For those of you who celebrate Easter, I hope you have a wonderful Easter weekend. And for all of you, I hope you have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.